Well, on the 12th anniversary of ET Now, we caught up with none other than Prashant Jain, who is the CIO and ED of HDFC AMC, to understand the investment opportunities in the current market context. In fact, speaking exclusively to ET Now's Nikunj Dalmia, Mr. Jain stated that value investing is not about buying companies around the book value or below the book value or buying companies in old businesses. In his mind, value investing simply says that I will pay a price for growth and whatever could be that assessment of growth, and I don't want to pay any aggressive price for that. The price would be justified by the current and future prospects. He stated that the corporate NPA cycle is clearly behind us and banks' asset mix has converged between the retail as well as between the corporate book, and this is across the PSU and private banks. And going forward, the big divide in valuations that we had seen earlier may not sustain. The world has underinvested in capital intensive or core sectors. Supply may not keep up the pace with demand, and that's why we are seeing a sharp increase in commodity prices, said Jain. And he stated that the rise in the interest rates will be more negative for expensive sectors like the consumer sector. Speaking about the underperformance in the PSU stocks, Jain stated that the PSU's underperformance was there significantly in the last couple of years, but that was not backed by the financial performance. The last 5 years, the profit growth of the PSUs was more than the broader markets, and he believes that the underperformance was possibly the result of the government opting for ETFs, and now with the government hinting that they would not be adopting for ETFs and they would be going for strategic sale in terms of divestments, he believes that the real value of these PSUs will be seen now, and the environment to that extent has surely turned positive. In fact, he believes that in the current context, at least in the Indian context, bulk of the PSUs are in banks, oil and gas, energy, coal, mining, and in the power sector, and these sectors have underperformed. Now, even the sectoral outlook has changed for these sectors. Profit performance is not supportive of these businesses. The profit performance is supportive for these businesses going forward, and the deep undervaluation is partly corrected, but he still believes that there is significant room in terms of valuation catch up in these sectors, as the valuations are still significantly below the long-term averages, and in some cases the dividend yield in quite a lot of these companies is even below the borrowing cost, and hence he is optimistic. He also believes that overall in terms of the markets, the valuations are fair as of now in the current context, as the markets are now trading at 90% of the market cap to the GDP ratio, and this is just about right. He believes that in the current low cost of capital, one can work slightly with slightly higher valuation multiples, and interest rates in India are not the lowest. While it has been the interest rates in US have definitely collapsed, but he believes that the capital markets can take some more increase in interest rates in its stride, and outlook for profit growth in India is positive and broad-based.